Imagine you are watching, nearly $1 billion of institutional cash just flood into a market in less than a week, right?
Hmm.
And the price just hits an absolute brick wall.
Yeah, it's wild.
That is exactly the setup we are unpacking in today's deep dive. So welcome. It is July 22, 2026, and we just saw 6 consecutive days of U.S. spot ETF inflows.
Right, totaling over $930 million.
Exactly, almost $1 billion. Yet Bitcoin's price got fiercely rejected at that $67,000 resistance level. What is actually going on under the hood here?
Well, the telemetry points to a persistently negative Coinbase premium. So the spot buying we are seeing on the ETF side is essentially being immediately neutralized
Neutralized how?
by heavy derivative hedging. So you have to look at the basis arbitrage.
Wait, I need to push back on that for a second. If $1 billion of new money is entering the space through these ETFs, shouldn't that eventually, force the price up?
You would think so, yeah.
Are you saying these institutions aren't actually taking a long position on the asset?
That is exactly what I'm saying, yeah. Many of them aren't. Instead of just buying and holding spot Bitcoin, these institutions are executing basis arbitrage.
Oh, I see.
Right? They buy the spot ETF and simultaneously short the futures. They just want to capture the yield spread between the two. That continuous shorting pressure acts as a ceiling.
So rather than acting as this rocket fuel for unhedged price discovery that all the retail investors expected, this massive wave of institutional capital is functioning more like a shock absorber.
A shock absorber is a great way to put it.
It's actually dampening the volatility just to farm the yield.
Precisely. The institutional capital is just engineering returns. They are prioritizing predictable margins over holding on for some parabolic ride.
Wow. Okay, so if Wall Street is locking down paper yield, we are seeing a similar, really ruthless hunt for margins on the physical side too, right?
Oh, absolutely. The infrastructure shift is massive.
Right, because miners are looking at their energy output and realizing Bitcoin might not actually be the most profitable use for it anymore. AI is.
Yeah, grid power simply flows to the highest bidder.
Exactly. Power Compute just rebranded. They announced they are dedicating 26 megawatts to modular AI GPU infrastructure over their dedicated mining.
Which is a huge chunk of power.
It is. So my question for you is the artificial intelligence boom actively cannibalizing Bitcoin's long-term security budget just because it offers better energy margins?
It's definitely forcing a fascinating structural shift. The math dictates it. Right now, the marginal value of energy deployed for AI data processing completely outstrips the block subsidy.
Right.
So global hash rate growth is flattening as a result of that.
Think about what that means for a legacy mining operation, though. You are totally backed into a corner.
You really are.
You either squeeze every single drop of efficiency out of your silicon, or you lose your megawatt allocation to an AI data center down the road.
And that completely explains the desperation we are seeing in the hardware markets right now.
Right, like with Genesis Digital Assets.
Exactly. They recently acquired 1,000 new air-cooled miners that boast these ultra-low energy metrics. This isn't just a routine network upgrade anymore.
No, it's survival.
Right. It's an arms race for semiconductor efficiency just to survive the current grid economics.
Okay, so while the physical layer is maxed out and hyper-competitive, the rulebook governing it all is actually finally opening up.
Yeah, we are seeing real movement there.
On the U.S. side, the SEC just issued this groundbreaking interpretation that bare digital assets and proof-of-work mining are not securities.
Which is huge. Removing that existential regulatory threat for domestic infrastructure providers is a massive structural modernization.
Yeah, and you couple that with the CFTC consulting on expanding standard futures to 24/7 trading hours just to match digital asset venues.
The legacy markets are clearly having to bend to fit the technology, not the other way around.
But, if you look past the U.S. administrative maneuvers, I think the real paradigm shift is how sovereign nations are weaponizing this infrastructure.
Oh, absolutely. Look at Russia.
Exactly. The Russian State Duma just advanced legislation to legalize cryptocurrencies for international trade, specifically to bypass SWIFT.
Right, while simultaneously maintaining a strict ban on domestic use.
It's wild. They want the borderless rails without giving up any internal monetary control.
And it perfectly validates a core macro thesis we've been tracking. Nation-states that are excluded from U.S. dollar hegemony are adopting decentralized ledgers as neutral settlement rails.
Which makes perfect sense for them.
It does. They can maintain absolute domestic authority while exploiting the permissionless architecture for cross-border capital flows.
So for you listening, if you have been sitting at your screen wondering why your portfolio isn't moving despite all this massive ETF news, this is why.
Yeah, it's all connected.
Getting distracted by a short-term price drop right now is honestly like watching the paint dry on a ship while the engine room is being replaced with a nuclear reactor.
That's a great analogy. The fault lines have shifted entirely from retail speculation to real sovereign and institutional integration.
Exactly. 21st century global finance is being permanently re-engineered around decentralized ledgers. But before we go, here's a forward-looking twist for you to ponder.
I like this one.
If the geopolitical and institutional landscape is securing Bitcoin for the present, what about the distant future? Galaxy Digital just launched a $5 million quantum readiness initiative.
Which is definitely necessary.
Because if the asset survives the regulatory battles of today, the next existential question for you is this. How will the protocol survive the federal government's 2031 deadline for quantum computing threats?
Right. Will that algorithmic shock absorber hold up when the fundamental cryptography itself is put to the ultimate test?